Welcome to Counters. In this lesson, we're going to be looking at subsequent events, which is IAS 10, otherwise known as events after the reporting period. We're going to explain exactly what it is, explain what is important for you to know, and go through some examples which will help you greatly understand this topic. Now, what are subsequent events? Well, these are events that occur between the year-end date or the end of the financial period and the date when financial statements are authorized for issue. Now, when you're looking at subsequent events, these dates are extremely important. You have to know what is your year-end date or the end of the financial period, as well as the date when the financial statements are authorized for issue. Now, we know that when the financial year comes to an end, that is not the date when the financial statements are authorized for issue, because there's still going to be some time that will pass before the financial statements are authorized for issue. And the reason for this is because it takes time after the end of the financial period to compile the financial statement. So we are actually looking at these two periods, whatever happens in between these two periods, when our financial period has ended and when the financial statements are authorized for issue. Financial statements are never finalized until a period of time has passed between the year-end date and the date on which the financial statements are expected to be issued, as I have just mentioned. Therefore, regard has to be given to events that occur between the reporting date and the date on which the financial statements are expected to be authorized for issue. Now, that's what I've just mentioned and explained. We have to pay attention to those events that happen in between those two dates. The question is, will it affect our financial statements? And if it does affect our financial statements, how so? And what do we need to do? Or what changes do we need to make to our financial statements? So like I've mentioned, we're looking at those two dates, the year-end date and the date the financial statements are authorized for issue. So I've given an example here. If the financial year end is 28 February and the financial statements are authorized for issue on 28 August, we're looking at the period from 28 February to 28 August. We're looking at events that happen between these two periods, and we're going to consider whether they will affect our financial statements and how they will affect our financial statement if they do. So in looking at subsequent events or events after the reporting period, two extremely important events are the adjusting events and the non-adjusting events, right? If you do not know what adjusting events are or what non-adjusting events are, then you will not be able to understand this topic well. But if you can get a grasp of what is an adjusting event and what is a non-adjusting event, then it will make it quite easy for you to understand any scenario when dealing with events after the reporting period. So you have to pay attention here to what is an adjusting event and what is a non-adjusting event. IAS 10 determines when an event that occurs after the reporting period will result in the financial statements being adjusted, or whether such events merely require disclosure within the financial statements. These events are referred to in IAS 10 as adjusting or non-adjusting events. So remember, these are events which will occur between those two periods, when the financial period has ended and when the financial statements are authorized for issue. So we just have to determine, is this event an adjusting event or a non-adjusting event? Remember, according to IAS 10, an adjusting event results in our financial statements being adjusted. All right, and we'll go into detail now. An adjusting event is an event after the reporting period that provides further evidence of conditions that existed at the end of the reporting period or at the end of the financial period, including an event that indicates that the going concern assumption in relation to the whole or part of the enterprise is not appropriate. It does not matter whether the event was actually known or unknown at the reporting date. So what is this saying here? Well, an adjusting event, or what will require you to adjust your financial statement, is an event that provides evidence of conditions that existed at the end of the reporting period or at the end of the financial period. And you will understand this much better as we go through the example. So if it seems a bit confusing now, you will get it. So these are events which gives evidence that actually this existed before the end of the financial period. So it does not matter whether the event was actually known or unknown at the reporting period. So let's say our financial year end is 28 February and we're told of an event, let's say in March, before the financial statements are authorized for issue, and we realize actually this event actually existed before the end of the financial period. That will be an adjusting event because it existed before the end of the financial period. This is even though we may not have been aware of it on 28 February if that is our financial year end. Alright? A non-adjusting event, on the other hand, is an event after the reporting period that is indicative of a condition that arose after the end of the reporting period. So what do you notice about these two events? Well, both events are known after the end of the reporting period. But if we have evidence that the condition existed at the end of the reporting period, then we know that it's an adjusting event. But if it's a condition that arose after the end of the reporting period, then it's a non-adjusting event. So it's important that we understand this very well. Let's go into more detail on adjusting events. An entity must adjust the amounts recognized in its financial statements or recognize items that were not previously recognized to reflect adjusting events after the reporting period. Remember, we have to make an adjustment to a financial statement if we have realized that this is actually an adjusting event. So we have to amend our financial statements. So the entity must adjust the amounts recognized in its financial statements or recognize the items which we had left out, but now we learn of this event which already existed at the end of the financial period. Now we have to include that amount. So again, for us to understand any topic, we need to go through examples. So what are some examples of adjusting events? Well, here is one: the discovery of fraud or errors that indicate that the financial statements were incorrect. So let's say again our year end is 28 February and the financial statements are expected to be authorized for issue, let's say on the 31st of May. So now we're looking at the period from the 28th of February to the 31st of May. But let's say in March, we realize that there was fraud, or we discover that there was fraud that was committed. Well, that means we have to make adjustments to our financial statements because the fraud existed at the end of the financial period, all right? Or we made errors, for instance, in how we accounted for some figures. Well, that means that we have to adjust our financial statement because it's an adjusting event. If it occurred at the end of the financial period, then that is what we have to do. Another example here we have is the determination after the reporting period of the cost of assets purchased or the proceeds from assets sold before the reporting period. So let's say our year end is 28 February and we are authorizing our financial statements for issue on the 31st of May. And in March of that same year, we learn of the cost of the assets that we purchased or the proceeds from assets sold before the reporting period. Then we have to make adjustments to our financial statements. Remember, we may not have all the details of the cost of the assets that we have purchased or the proceeds from the assets that we sold before the reporting period. Maybe we're going through negotiations and we're trying to get to a price that we wanted and we only got that after the end of the reporting period, but before the financial statements are authorized for issue. Then we have to go back to our financial statements and adjust them accordingly. That is another adjusting event. So if you see any of these two scenarios so far, then you know that it's an adjusting event if it's indicative of a condition that existed at the reporting period. Third one here we have is the resolution of a court case, which, because it confirms that an entity already had a present obligation at the reporting period, requires the entity to adjust a provision already recognized or to recognize a provision instead of merely disclosing a contingent liability. All right, so maybe in our financial statements as we are preparing them after the end of the reporting period, we mentioned that there's an ongoing court case and there's a probability that we may or may not have to pay an amount to whoever is taking us to court as a company. But then after the reporting period, let's say in April, continuing with the same example of our year end being 28 February, and we're authorizing our financial statements for issue in May of the same year. In April, the case is concluded and we learn what the actual verdict is. Let's say the court orders the company to pay 10 million rand. Well, what we have to do is to go and make that necessary adjustment. It's no longer a contingent liability, but it's something that we know for a fact we have to pay. So we have to go and adjust our financial statements. Why is that? Well, if it was an ongoing court case before the end of the financial period, then it is an adjusting event because it's a condition that existed at the end of the reporting period. I hope you're getting an idea of what adjusting events are here. All right. So remember, a court case can begin after the end of the reporting period. That means that it's not an adjusting event because it means that at the end of the reporting period, it was not something that existed. So you have to pay attention to that. But usually when you're given a court case or when you're told of a court case, it usually is something that would have been ongoing at the end of the reporting period. But if it's something that only starts after the end of the reporting period, then it's not an adjusting event. So remember, it has to be something that you know existed at the end of the reporting period. Here are more examples. The bankruptcy of a customer which occurs after the reporting period usually confirm that a loss already existed at the reporting date. Now, this is a common question that is asked, or a common scenario that you are given when you're dealing with events after the reporting period. You will be told that one of your biggest customers or a customer has gone bankrupt or is unable to pay you your money. Well, this usually indicates that the loss already existed at the reporting period. Remember, usually no one really goes bankrupt in one day, but you can see that there was a struggle for some time. So if you are told that a customer has just gone bankrupt, then it indicates that the condition already existed at the reporting period, meaning the customer may have been struggling already at that point. So it is an adjusting event. So now you put the actual amount that the customer is unable to pay you, whether it's the full amount or some of the amounts. But again, you have to be careful. If the examiner chooses to tell you that the customer has gone bankrupt, and the reason he has gone bankrupt is because after the end of the reporting period, there was a fire and it destroyed their entire facilities and they were not insured, for instance, then you know this is a non-adjusting event because it occurred after. But if you're not given any further details and you're just told that the customer had gone bankrupt, then you will assume that it existed at the end of the reporting period. So it is an adjusting event. Another one we have here is the sale of inventories after the reporting period below cost. If we are selling our inventory below cost after the end of the reporting period, then we have to adjust our amounts accordingly. Remember, we will have recorded our inventory in the statement of financial position, but if we end up selling this inventory below cost, then we have to make the adjustment. I hope that has made sense thus far. Now let's look at non-adjusting events. What are some examples of non-adjusting events? Well, remember what non-adjusting events are. An entity must not adjust the amounts recognized in its financial statements to reflect non-adjusting events after the reporting period. What is this saying? Well, we do not adjust the amounts that we have in our financial statements if it's a non-adjusting event. We can make the disclosure in our financial statements, but we don't adjust the actual amounts. What are some examples of non-adjusting events? Well, the first one here is the decline in market value of investments between the reporting period and the date when the financial statements are authorized for issue. Remember, the market value changes all the time based on market conditions. So if the decline happens after the reporting period and before the financial statements are authorized for issue, then you can merely make a disclosure, but you don't adjust the market value of investments in your financial statements. You don't adjust the actual amount because it's a non-adjusting event. The second one we have here is the announcement of restructuring after the reporting period. What matters here is the date when that announcement is made. So if the announcement is made after the reporting period, then you know that this is a non-adjusting event. You don't adjust the amount. You can have a disclosure mentioning that this happened after the reporting period. The third one we have here is announcing a plan to discontinue operations. Again, the date of the announcement is what matters here. Did it happen after the reporting period and before the financial statements are authorized for issue? If yes, then we know that it's a non-adjusting event. The fourth one we have here is a destruction of a part of the business by a fire after the reporting period. So this can happen. Let's say our financial year end is 28 February and we're authorizing our financial statements for issue in May, and in April our factory catches fire. Well, that can have a significant impact on the business, but we do not adjust our financial statements. We will have a note, however, mentioning the event and what had happened, and we'll explain exactly what you need to disclose when you have a non-adjusting event. And the last one here is changes in tax rates or tax laws enacted or announced after the reporting period. So you can see here what matters is when it happened. Okay, if it happened before the reporting period, then you know it's an adjusting event. If it happened after the reporting period, then you know that it's a non-adjusting event. So what do you need to do when it's a non-adjusting event? Well, when non-adjusting events after the reporting period are of such importance that non-disclosure would affect the ability of the users of the financial statements to make proper evaluations and decisions, an entity must disclose the following information for each significant category of non-adjusting event after the reporting period. So what are we saying here? Well, if the non-adjusting event is material or can affect the decisions of the users of the financial statement, if I omit it or if I include it, then this is what I need to disclose. The first one here is the nature of the event. It's a fire. I need to explain exactly what happened. And the second one here is an estimate of its financial effect, or a statement that such an estimate cannot be made. So let's keep the example of fire, for instance, and it has destroyed a section of our factory. Well, if we have the financial estimate of how much it's going to cost us or how much that fire has destroyed, then we need to disclose the amount. Or if we can't disclose the amount, we need to make a statement that we cannot make an estimate. All right, so we have to estimate what the amount is, otherwise have a statement stating that we cannot make such an estimate. All right, so now after going through all this theory, let's go through some examples, and hopefully you'll be able to apply it well in our examples and remember what we have been discussing thus far. Here is the first example. Villa Cargo Limited is a cross-border logistics company. Its year end is 28 February of 2021, and the following came to your attention before the financial statements were approved on 21 May 2021. For each of the events, you are required to discuss whether the financial statements require amendment. And here is the first one. A debtor with an outstanding balance of 50,000 Rand on 28 February 2021 was declared insolvent on 15 March 2021, and his estate will pay the company 40 cents in the rent. No allowance for credit losses was made at reporting date. So what you can do here is pause the video, attempt to make an explanation of what you would do here, whether it's an adjusting event or a non-adjusting event, and you can attempt to say, if it's an adjusting event, what will we do exactly, or what amounts do we need to make an adjustment to. So after you read each of the scenarios before I explain what the solution is, then you can attempt it and continue the video and gauge your understanding. So what do we have here? A debtor with an outstanding balance of 50,000 Rand on 28 February 2021. So obviously our year end is 28 February 2021, and the financial statements were approved on 21 May 2021. Okay, so we are dealing with everything that happens between those two dates. So on 15 March 2021, the debtor was declared insolvent. So obviously that happened within those two dates, and his estate will pay the company 40 cents in the rent. Again, we are not given further information to indicate that the event occurred after the reporting period, so we will assume that this gives evidence of a condition that existed before the end of the financial period. Like I mentioned when I was explaining, nothing happens in a day, especially insolvency. It doesn't just happen in one day. So this is exactly how we'll account for it. The bankruptcy of a client which occurs after the reporting period usually indicates that a loss already existed at the reporting period. But as I've just mentioned, remember, unless you're given specific details to indicate that this happened after the reporting period. The amount owed by the debtor therefore needs to be adjusted in the financial statements for the year ended 28 February 2021. So even though this happened after the reporting period, it gives evidence of a condition that existed at the reporting date. So here is exactly what we'll do. We will debit a credit loss, and we'll take 50,000 Rand that he owed us times 60 cents. How did I get 60 cents? Well, if you'll pay us 40 cents in the rent, that means the remaining 60 cents is going to be bad debts or credit loss. That is what we'll have to record. So obviously that's going to affect our income statement or the statement of comprehensive income. The credit loss is an expense, so we have to include that amount of 30,000 Rand, and allowance for credit loss 30,000 Rand, as an allowance was not initially created, which is a negative asset account, and it's going to go into our statement of financial position. This is the adjustment that we need to make in our financial statement because this is an adjusting event. Remember, it gives evidence of a condition that existed at the reporting date. I hope the explanation was clear and you were able to connect it to this example and apply it here. All right, I hope if you attempted it, you got it correctly. Let's look at the second one. You can attempt it and then continue with the video after you have made the attempt. On the 2nd of May 2021, a section of the building with a value of 2 million Rand was destroyed by a fire. This section was insured for up to a value of 1.5 million Rand. Now again, this event happened between the end of the financial period and when the financial statements are authorized for issue, all right, because we know that they were approved on the 21st of May. So this fire happened on the 2nd of May, all right. So the question is this an adjusting event or a non-adjusting event? Well, if a section of the building with a value of 2 million rand was destroyed by a fire, the fire happened on the 2nd of May, which is after the reporting period. That means this is a non-adjusting event. So usually, let me give you a hint. If you are dealing with any natural disaster, whether it's fire or an earthquake or anything of that nature, and it happened after the reporting period, you automatically should know that that is likely a non-adjusting event, as we have here, because the fire happened on that date, unless you would think that the fire was started before the end of the financial period and we found out about it on the 2nd of May. Obviously, that's ridiculous, but that is exactly what it is, a non-adjusting event. All right. So what do we do with this amount? We know that it's a non-adjusting event. That means we don't adjust the amounts in our financial statements because it did not exist at the end of the financial period. So the office building that was destroyed on the 2nd of May 2021 in a fire is an event that took place after the reporting period. As we have mentioned, there was no liability at the reporting date. The entity does not adjust the amounts recognized in its financial statements. However, a disclosure stating the nature of the event, explaining exactly the event surrounding the fire, and an estimate of its financial effect, or a statement that such an estimate cannot be made will be required, as non-disclosure would affect the ability of the users of financial statements to make proper evaluations and decisions. Remember, if it's a material amount, you have to mention these two: the nature of the event and an estimate of the financial effect. Well, we have actually the estimate here. We're told that this section was insured for up to 1.5 million, and we know what the value of the office building is that was destroyed. So we have the amounts here, so we need to mention them as well as the nature of the event. I hope it's becoming easy on what you need to do, whether it's an adjusting event or an unadjusting event. Let's look at another example here. On the 2nd of March 2021, you know that is between our year end and the date of the approval of financial statements, the entity declared a dividend of 70 cents per share for the year ended 28 February 2021. It has 250,000 issued ordinary shares. Again, you can pause the video here, attempt it, and continue with it once you have. So I hope you have attempted it. What do we do with this one here? Well, if the dividends were declared after the end of the reporting period, which is the case here because it was declared on the 2nd of March, and we know our year end is 28 February, then we know that this is a non-adjusting event. So if dividends are declared after the reporting period, an entity should not recognize those dividends as a liability, as they do not meet the criteria of a present obligation. All right, they were not a present obligation at the reporting date. Therefore, the entity does not adjust the amounts recognized in its financial statement, obviously because it's a non-adjusting event. However, a disclosure stating the nature of the event, all right, and an estimate of its financial effect, or a statement that such an estimate cannot be made will be required as non-disclosure would affect the ability of the users of financial statements to make proper evaluations and decisions. So you're explaining that on the 2nd of March 2021, the entity did declare this dividend, and you have to mention the amounts because we are given the amount. So we have the estimate here, so it's 70 cents per share, and we have the number of shares. So we know exactly what the amount is: 70 cents per share times 250,000 ordinary shares. It will give us how much the dividend amount is. So remember, it's a non-adjusting event. We don't adjust the amounts in our financial statements, but we do have to make a disclosure. Let's look at another one here. On the 25th of March 2021, again, in between the two dates, the end of the reporting period and the date when the financial statements were approved for issue, the market value of a listed investment decreased by 860,000 rand. Investments are stated at market value. Assume that the company does not speculate with shares. What do you do with this one here? Well, you can again pause and try it, and then you can come back and follow our explanation. Well, we explained this when we looked at our theory. We said that if there's a change in market value in our investments, then this is an event that occurred after the reporting period. That means that it's a non-adjusting event. Again, you can see here that a company does not speculate with shares or estimating where the shares will move in the future. So the change in the fair value of the publicly traded shares is a non-adjusting event after the end of the reporting period. The change in the fair value is a result of conditions that arose after the end of the reporting period. The entity does not adjust the amounts recognized in its financial statements. So once you have established that it's a non-adjusting event, you know that you have to mention that we do not make an adjustment to the amounts we recognize in our financial statements. However, a disclosure of the nature of the event and an estimate of its financial effect, or a statement that such an estimate cannot be made, will be required. All right? And remember, this is provided that the amount is material. So let's say that the market value of the listed investment changed by an insignificant amount. All right, so you'll have to look at that. If it's a very insignificant amount, then you do not have to make a disclosure, because it will not affect the ability of the users of financial statements to make proper evaluations and decisions. But if it's a material amount, then you have to make such a disclosure. Let's look at the last example. We're told here that legal proceedings against the company in relation to a breach of contract was initiated by the company's client on the 10th of February 2021. Again, that is before the end of the financial year. And on the 9th of April 2021, the court found the company liable and is now required to pay damages amounting to 5 million rand. Again, you look at the dates here, very important. We know that our year end is 28th of February, and we know that the legal proceedings was initiated on the 10th of February, so that is before the financial year end, and it was concluded on the 9th of April, where the company was liable to pay 5 million rand. So that means this is an adjusting event because it existed at the reporting date. Very important. So if it's an adjusting event, we know we may have disclosed a contingent liability that possibly we would have to pay or not have to pay based on what the facts were at the time. But now that we have the information, we have to make adjustments in our financial statements. The legal proceedings were issued before the end of the reporting period. This is therefore evidence of conditions that existed at the year end. IAS 10 requires the result of a court case after the reporting date to be taken into consideration to determine whether a provision should be recognized in accordance with IAS 37 at the year end. In this case, the financial statements will require adjusting because the conditions existed at the year end and the recognition criteria for a provision in accordance with IAS 37 have been met. I hope you attempted this question, and I hope you're able to get the right answer. Remember, if the legal proceedings were initiated before the end of the financial period, then you know that it's an adjusting event. But if the legal proceedings were initiated after the end of the financial period, then you know that it's a non-adjusting event. You may have to just do a disclosure, but in this case, it's an adjusting event. So we have to adjust the amounts in our financial statements. I hope it has made sense. I hope you've gained value from this lesson. And if you have, consider subscribing to our channel, like this video, and share it to those you think it might help. Till next time, cheers.